All right. Good evening, everybody. Happy Tuesday. Happy day after Christmas. We were out and about. We stopped into Target just for a minute. Oh, it was a madhouse. I'm like, oh, let's get out of here. Terrible. I hope everybody had a wonderful holiday. I think I saw most of you this morning. We talked about this market of ours and how we still like it and still looking pretty good. IBM trade moving well. I know a few are in that. Our calendar spreads that we've been playing around with and diagonal spreads, those are working well. Directional trading working well. Low volatility uh, uh, strategies working well. Good evening, Stephen. Good to see you. Hi, Perry. Good evening, Bob. Bob still down in LA. Anyone else traveling? Bob's in LA visiting family. That's a long way from Maine to LA. That's like literally about as far across the country as you can get, man. Oh, it's Rhode Island. That's not that much different. You're like, oh, there's a big difference between Rhode Island and Maine. When you're out here in the West, we see it all the same. Oh, good. All right, let's just give it another second or two to get everybody in. How's everybody else doing? It's good to see you all coming out to further indulge our exploration of options. We are in December, the options month of options extravaganza, a festivalazzo of options. Everybody else good? All right, let's dive in. Took the plunge, took the IBM, love it. Yeah, plenty of signals and opportunities. We saw a ton of them this morning. Market looks fine. Oh, you'll notice. I hope you all noticed what the VIX did, but the VIX, which in the beginning of the day, we're all like, oh, what's going on with the VIX? It's up a little again, even though the market's up. I said, give it time. Give it time. We gave it time. It came back down, confirming that the fear levels in the market are at strong, low levels. AI confirmed IBM. Nice. Love it. Love to hear it. Excellent. Welcome to the Market Watch Group Options Foundation. Second to last session. Good news. Gary is going to wrap us up on Thursday. Gary Pacanini, good friend of mine, phenomenal trader, great coach. I got to have someone else here with me. He's going to start joining us in Discord. He is going to start taking some presentations, getting him so that if I'm out, I don't get sick. I mean, everyone's like, oh, I don't get sick. I really don't. I don't take sick days. I grind. I'm a grinder. But you know, gotta have someone else who's in line with our group, and he's the right one. So very excited. I chatted with him today. He's all set. So he's gonna wrap us up on Thursday. He's not closing out the year. I wouldn't let him close out the year. I'll close out the year on Friday. That's my job. I guess technically on Sunday we'll have one last market posture session on Sunday, but the posture's for next week. So, all right, so that's what's happening. Welcome everyone. Today we're talking about advanced combination spreads. So we talked a little bit about some neutral or neutral to bullish strategies when implied volatility is low. We did that first because implied volatility is low. This week, we're talking about some advanced combination strategies that include butterflies and iron condors. These are strategies that are going to be more inclined for high implied volatility markets. Remember that next week, we're wrapping up with the Greeks. We're going to wrap up with the Greeks. Although, as I think about it, I might put the Greeks more to the beginning next time with the matrix. It's hard because you don't know if it's the chicken or the egg. A lot of times you're like, well, I can't really understand how the Greeks works till I understand the strategy. Can't really understand the strategy without knowing how the Greeks work, and you kind of go back and forth. So the second time around, I'll go a different direction. We'll see how it feels. But we're going to be talking about implied volatility, delta, gamma, theta, vega. And included in that, there will be a matrix, a trade matrix, where we're able to basically just say, if I'm bullish and the implied volatility is low, here's what I'm considering. If I'm neutral and the implied volatility is high, if I'm neutral and the implied volatility is low. It's not a complex matrix. You could certainly take that matrix and really, sophisticate it. You could say, well, what if it's medium volatility? What if it's right? What if I'm slightly bullish? Nah, we don't need to do that. We can just get a basic matrix that'll help you to just kind of say, wait, I'm a 6. The implied volatility is strong, which means it's low. What do I do with that? I buy options. I do calendar spreads. I do diagonal spreads. Right? That's where we are right now. That's what we did. They're all working. But what if I'm neutral and the implied volatility is high? And that brings us to these advanced combination spreads. Here are our disclaimers. As always, here is today's agenda. We're going to discuss an intro into the advanced combination. There's a lot of different spreads. We don't need to know them all. What I've given you is everything you need. Buying options, buying calls and puts. Then we talked about vertical spreads, which are our directionals, credit and debit spreads. Those are ways to still take our directional trades even when implied volatility is higher or time may take longer. Then we said, we talked about selling options, and then we talked about the spreads. Then we said, well, what about time spreads? What about when we're neutral? What about when the market starts to just go sideways? I can remember times, especially after a strong bull market. I'm expecting a strong bull market. 2003 was a strong bull market coming after the big sell-off of the tech bubble. 2003 was phenomenal. 2004 and 2005 didn't do a damn thing. Nothing. What did I do? Floundered, trying to take directional trades. Well, if there's no direction, it's hard to take directional trades. So I realized that's when I really accelerated my options. Here's a great book. I'm going to give you this one. I know Sandy gets these. This one's heavy. This is the book that if you were to go get a job on the Chicago Board of Options Exchange, if you were working at the pits of the CBOE, this is the book they would start you on. It's called Option Volatility and Pricing. It's written by Sheldon Natenberg. I have a good friend that was a coach with me and a trading partner of mine. That he was, right? He moved out here to ski, got a job with the education company. He was a market maker in the CBOE. He said, this is the book. So I realized, man, if I would have had these strategies, I would have crushed 2004 and 2005, not struggled. We have to make sure that we have everything we need by way of pricing or by way of strategies. Option, I'm typing it now. Volatility and pricing. Sheldon. I might be spelling his name wrong. Could be B-U-R-G, not B-E-R-G. But that's essentially it. Option. It's a green cover. I know that. The green cover. Pick it up. It's heavy. I promise you it's heavy. But it's worth it. Phenomenal. We're going to talk about the combination spreads. We're going to explore butterflies and condors. So we did time spreads last time. We did calendars and diagonals. Calendars sideways. Diagonals are more directionally biased, but that's neutral and bullish. We don't do, if you think the market's going to drop and the volatility's low, buy a put. That's the strategy. You're hedging that or you're speculating, but buy a put. That's the best way to capitalize. Because if the market drops, the market's dropping, it typically goes fast and volatility is typically rising. Those three things all would benefit buying a put. There's no other strategy better than that. We don't need a strategy for, right? Because that's all we need there. Today, we're talking about strategies that we're probably not going to use right now. because these are better equipped for higher implied volatility markets. These are what are called Vega negative strategies. Vega negative means they will benefit when volatility drops. If something would benefit from volatility dropping, where do we want it to start? High. That means it has plenty of room to drop. If it's starting low and you're thinking it's really low vol, I might make good money if it drops from 12 to 11. No, that's not a strategy. You make good money if it goes from 12 to 30. And that's what happens when markets collapse or whatever. That book is only 400 pages. That's it. It's pretty heavy in those 400 pages too. I'm just saying. You'll enjoy it. It's good stuff. It's good stuff. It's already on order. It'll be shipped by the time we're done for Sandy. So you guys are behind. You got to play catch up with her. Gold star to whoever comes back and says they finished it cover to cover. That'd be amazing. All right. So we're going to explore butterflies and condors. Butterflies first, break it down into 2 parts, then we'll do condors, 2 parts. Generally discussing the advantages and disadvantages. They're very similar. I'll tell you that. They're very similar. I'll give you a quick visual representation since we're all getting so much better with risk profiles. This is a butterfly. And you might say, Scott, that looks just like a calendar spread. It is. What's the difference between a butterfly and a calendar spread? If it was a calendar spread, we benefit when vol is rising. If it's a butterfly spread, I'm going to put butterfly because I'm not going to just put but. Then we benefit when vol is dropping. Yeah. Otherwise, these risk profiles, Sandy, that's the Australian in you. You guys are known to be a party bunch. Calendar volatility rising is better. Butterfly volatility dropping better. Natenberg with 1T. I was close. Natenberg with 1T, Bob said. Now, what is a condor? Well, what if I was willing to lop the top of this off? Shoop. And say, I don't care about this. Now what do I have? Well, what I might get is I might get a broader range, right? I sacrificed the peak to get a broader range. But no matter what do we get? What's in the middle? Are they both limited gains? 100% yes. All spreads. The second you put the word spread with a strategy, your gain is limited. Well, that's what a spread does. You're sacrificing something, which typically is the potential for gain, in order to gain something. What do we gain? We gain increased probability because we go from time being against us to time being for us, right? There's a gain there, but basically the difference between a butterfly and a condor is lop the top off, spread the outer edges of the trade a little bit more width. However, I'll tell you this, butterfly can be adjusted. If I put one on and then I put another one on, it sort of connects these two in the middle, right? Because if I were to watch this thing from a risk profile, it's going to look just like that too. Just like we can expand a calendar by adding one, we can expand a butterfly by adding one. What about the loss? Loss is fixed, right? On this risk profile, you'll notice these bottom edges are flat all the way out both ways. So there is a fixed amount of potential loss. Okay, now real quickly, I felt comfortable using that white space to draw these risk profiles. What did you think? Did they make sense when I drew those? Were you like, oh, I see what you're saying? Because if so, that's absolutely amazing. I love that. That's how we learn. That's all I need is a risk profile. That tells us everything we need to know. So Steven said yes. Fred said yes. Oh my God, you guys, that's amazing. So cool, right? When you're like, oh yeah, I know what the risk profile looks like. Come on, of course I do. Let's get into it. Butterfly. So condors, advantages, disadvantages, tips for success, pitfalls to avoid, the usuals. So let's just give it a quick introduction. Building blocks. That's what we've been going through the whole time, right? We start with some terms and some definitions, and then we say calls and puts. And we start from the perspective of a buyer. We have rights. We have rights in these contracts, these option contracts. So the definition of options, we're buying and selling contracts that give the buyer or the holder the right, but not the obligation. We have calls and puts and strike price and expiration dates. Then we start selling them. Now all of a sudden we're doing covered calls. Now all of a sudden we're selling cash secured puts or even naked puts. And then we say, oh, you know what? What if I do both? We start to talk about these spreads, these debit spreads, these credit spreads. And then we start to think, well, what if I want to come in more as a net seller than a net buyer and give myself the ability to do some, make some money from time decay in a low implied volatility environment? And now we're doing the same thing. We're saying, what if I were to combine these things? Every spread we've done so far has been a two-legged spread, 2 legs. And now we're moving on to 3 legs with the butterfly, 4 legs with an iron condor. So is it more sophisticated? Is it a little more complex to understand? Of course. Is it worth it for us to do it in order to expand our capabilities to trade effectively in any market condition? And we are very specific about how we see market conditions. Yes. So what is the need for these strategies? Market complexity. As markets evolve, basic strategies aren't enough. It's not enough to just be like, oh, just buy calls all the time, buy calls. Sometimes it's great. Sometimes it's great. Well, what's the opposite of that? It's not always great. Sometimes it's the worst thing we can do. And we need to be very, very careful about that. So this is going to give us more flexibility, more adaptability to match our option strategy, the matrix we're talking about looking at next on Thursday with Gary. We're talking about that as giving us more ability to match our market posture with the exactly right option strategy. Risk management. Advanced strategies provide enhanced risk management capabilities, which are obviously crucial for safeguarding investments. Question came in from Sandy, says, is it the increased sophistication of traders that have made the markets more complex? I would actually say it's the computers. It just makes everything faster, right? There's a lot of program trading, quant trading is what they used to call it. Now they call it AI trading. And you set up these models and the computer's just firing, and that makes it a little more sophisticated. But I'll tell you what, once we understand these concepts, if you just have to make sure we recognize it and apply the right strategy for the right market. I promise that what we do supersedes anything that AI would have the ability to come up with, as far as that goes, for me. So, okay, let's get into the strategies. Butterfly spreads, iron condors. Butterfly spreads are a long strategy typically. What I'm doing, and I'm gonna show each of these in the risk in Thinkorswim when we get to the 2 different slides that correspond with the different strategies. This is just a basic overview. It's a neutral strategy that combines a bullish spread and a bearish spread at the same time. So essentially, I'm going to draw a mini risk profile. If I have something that looks like this, and I have a break even down here somewhere, that if someone said, what is that, Scott? I'd say that's either a bull call or a bull put. I can't tell which from here, right? All I know is it's some sort of a vertical bullish spread. Well, now what if I did one the other way? and I did a bear call spread. Well, what's going to happen is this is all going to cancel itself out. Like that. That was the sound of canceling, if you were curious. And now I'm left with this. So I have a bull call. So let's say it's a 50 by 55 bull call. And I have a 60 by 55 bear call. What do I want it to do? Well, with the bull call, I want it to stay above 55. And with the bear call, I want it to stay below 55. So where do I want it? I want it as close as I can to right smack dab in the middle. And what's going to happen is it's going to look like this. And as time ticks and it stays in between, let's just say it's around 52 to 58, right? If it stays in that range, this thing keeps on raising up and we make money from time. It's a neutral strategy. I want it to stay range bound. What happens then if implied volatility rises? It's going to push down the trade. Implied volatility rising is better for a calendar spread. If implied volatility is falling, it's going to make this thing make money faster. So if you're ever in a situation where you're like, man, the market dropped hard, but it seems to be stable here. Seems to be. Well, if you're coming out of a bear market, it might be there. It might be there for months. Like, for example, the end of 2022. We kind of stayed in the same basic area for like November, December, January into February. It moved around some, but not enough that we would be overly concerned. That's where butterflies do well. Makes good for sideways trading. Absolutely right. Right? That's absolutely right. So that involves 3 strikes. I've got this one that I bought down here. I've got this one that I bought up here, and I sold 2 in the middle. Here's how I remember butterflies. You guys ready for this? Oh, to this day. You buy the wings, you sell the guts. Buy the wings, that's out here, and that's out here, 1 each. Sell the guts, 2 in the middle, times 2. That's all you need to know for a butterfly. Buy the wings, sell the guts. Okay, what's an iron condor then? It's also a market neutral strategy, but this time instead of doing 1 debit spread and 1 credit spread, we are going to change this bull debit to a bull credit. We're going to make it a bull put spread. We're going to push it a little farther over to give us more range. So we have a bull put spread, which is a credit, and a bear call spread, which is a credit. To profit from low market volatility. We're not profiting from low volatility, not IV. I want you to remember, these are different. It's not low implied volatility. We want high implied volatility. We want low market volatility. Meaning what? Options are expensive, but the market's just not really moving very much. Up and down, but not really going in a direction. That's what we're looking for. Now, iron condors are more rigid because you've got 4 different strike prices that create your range. 4 different strike prices, okay? Both strategies are designed, my low, again, I needed to put this in here. Low market volatility, meaning the market is sideways. We want the option volatility to be high. The more expensive the options are, the better these strategies do. This gives us an ability to seek a balance between reward and risk while trading a neutral market. Otherwise, if it's a neutral market, there's not much you can do with it, right? You sit around, wait. I don't want to sit around. I want to trade these. Okay, let's keep going. Let's keep going. What's next? Butterfly spreads, part 1, definition and purpose. A long call butterfly, we buy the lower strike, sell 2 in the middle, buy the higher strike. Buy the wings, sell the guts. What about a long put butterfly? Same thing. You buy 1 lower, sell 2 in the middle, buy 1 higher. Butterfly is agnostic. It's agnostic to whether it's calls or puts. Doesn't matter. Some people are like, oh no, calls are better. No, they're not. That's mathematically, that's just not true. Maybe they've had more luck. That's anecdotal. That is not mathematical, I promise you. I've played with the models so many times over the years. And same thing, like I said, with debit versus credit. It's a preference. It's not that someone can statistically prove one can outperform the other when all other variables are the same. You just can't. Same thing. Now, I have a tendency to use puts with my calendars and calls with my butterflies. Why? Because sometimes if they overlap, I don't want one to accidentally cancel the other. Meaning if I'm putting a new trade on and I accidentally buy one that I had some short contracts on, the trade would still behave the same way, but it looks funny and it looks harder to close, and I don't like that. Why am I telling you this? Because if I start with a butterfly and all of a sudden the market goes screaming up and the volatility drops, and then I think it's at a resistance, I'm going to be in a bad spot with that butterfly. But if I add a new trade, I can extend my ability to make money. How would I do it? Well, if the volatility had dropped, I'm not going to add a butterfly to the butterfly. I'm going to add a calendar to the butterfly. And if I start with a calendar when the volatility is low and the market drops and the volatility rises, in that risen implied volatility, I don't want to add a calendar. I want to add a butterfly. It's higher vol. And they give me the ability to sort of lock in the fact that I've gained already. If I have a calendar and the volatility rises, I've benefited from that. But not if I don't lock it in. How do I lock it in? By selling some of that vol with a butterfly. What kind of timeline would define this? So my timelines never really get beyond about 30 days, right? I want the ability to roll it possibly. We have a diagonal spread. We have a diagonal spread out to February. And in that situation, did I just advance my slide? Yeah, sorry. And in that situation, we talked about the fact that if it's still doing well and we get towards the end of January when the middle of January when the short option starts to expire, we can close it for a gain, and then we could sell another one further out in time, further out of the month. 2 more weeks, and then we could do it again for 2 more weeks. That would be rolling. I don't typically roll. I typically close. I'm not saying it's a bad thing. It's just not the strategy that I've typically used. How do you measure market volatility? VIX. VIX is the easiest. If you're looking at the S&P, if you're looking at the NASDAQ, the VIXN, VXN, that measures volatility on the NASDAQ options. If you're looking at the Russell, RVX is a implied volatility index for the Russell 2000. VXD is the Dow. I mean, anything that trades options has implied volatility. But here, since we're saying the broad market, well, we use the VIX. Right now, where's the VIX? Low. So what are our strategies? Likely going to be Vega positive strategies, which are calendar spreads, which are long options, which are diagonal spreads. Absolutely right. Bob said, so we are low right now. Correct. Okay. How do we construct these? We have to select the strike prices, and we're trying to create a profit zone between the lower and the higher bounds, which clearly means between the strikes that you buy. So if you say, I'm going to do a butterfly 55, 56, 57, your range is between 55 and 57. Is that a good range? No. Clearly, 2 points is not enough. I would want to widen it by picking wider strikes. Buy the 50, sell the 55 times 2, buy the 60. Right? And then we look to understand what the risk would be, and then we move forward. Determining strike prices, where are we, and where do you think it's going to stay? That's the main thing. Is have you decided the market's neutral? Great. Then we're going to try to put that thing. We can bias it up a little or down a little, but for the most part, we're putting it neutral. If we have to adjust it because it moved up or down further than we thought it would, then we do it. Otherwise, we expect it to stay where it is. Implied volatility characteristics and considerations, they should be high. They should be high. Managing as time ticks with all of these. This is not a, hey, how can I squeeze as much as possible? This is, hey, how can I maintain high probability of success? So if for example, when we're doing counter spreads, we said we might do these every week. So if I do one this week and next week I'm thinking about doing another one and I have some money on the first one, I'm going to take it. And then I'll put the next one on. And if I can go a week at a time, if I can do a week at a time and never have it move on me, I'm going to just keep booking little gains, book another one, book another one, book another one. Where is the price of the underlying relative to the strike? Ideally, Fred, wonderful question. Ideally, we're going to be very close to the short strikes, to the guts, because that's where our sweet spot is. Now, if I'm at 50 and I think the market's going to go between 50 and 55, then I might put my strike at 52 or 53. So it's in the middle, and the closer it is. Wherever you think it's going to land, that's where you put your short strikes. Because the short strikes, the guts, that's where your sweet spot is. That's where you would make the most amount of money if it stays close to that level. Great question. Tell me if that answered it or not. Let me know if you have additional questions. Okay, I'm not going to do iron condors yet. I'm going to go build one. Whoops, I don't know what I just did. Oh, there we go. Let's go out of here. Let's go into here. Look, everything's going well. IBM, I think I only put 2 contracts in this paper account. Even 2 contracts is starting to make some money. So that's directional. What do you notice about this, the IBM? Delta, positive. Theta, negative. Vega, positive. What does that mean? I own calls. That's how I know. The delta's positive. That means I want the market to go up. Theta's negative. I'm losing on time. I lose on time when I buy options. Vega, positive. When I buy options, I'm Vega positive. When I do calendar spreads and diagonal spreads, Vega positive. You'll notice that this SPY is bringing balance. This is negative. It brings this down a little. This is positive theta. I'm making money from time now. This is Vega positive. I'm making money if volatility goes up. What if it doesn't? What if volatility goes down? So now what? Now we come in here. I'm going to go, I can't keep putting trades on the SPY. Let's look at, that looks bullish. That looks bullish. They all look very bullish. This is not the ideal time, but I'm going to show one anyways. Let's just go with the IWM. And with the IWM, my thought process here is that, well, the IWM actually does have relatively high vol. This might be okay. Let's say that we think it's going to end up at 205. Could go up and come back down, could drop and go up. Let's say 205. That's where we think it's going to be. Okay. I'd like to have at least above here, like 199 and up to maybe 211 if I could. That might be hard to create, but let's just see what we can do. I'm going to go out in time a little bit. So I'm going to go, well, let's start with Dow 24. Let's go. All right, we'll stay here. I'm going to go butterfly. What do I have on the butterfly? 1, 2, 3. 1, 2, 3. These need to be monitored. I mean, I'm not going to let a trade go a day, right? I'm going to look every day. But yes, if it moves too far one way or the other, we've got to make an adjustment. So yes. Now we said we thought it would be 205, right? So let's go to 205 in the middle. Now this is 204 by 205 by 206. It costs 4 cents. So if I did 10 contracts, that literally cost me $40, $40. But what does it give me? It gives me that. Look, if it stays in this $2 range, $2 range? No. So what do? We widen it. And we say, what if I go down to 200 on one side? Can I have a broken wing butterfly? Yes, I can. A broken wing butterfly is similar to a diagonal spread where I have the benefits of the butterfly here and I have directional benefits here. I'm going to have to save that for next time, but we can do some fun things. Now what? Now you can see I'm starting to get a little more width. Now I have from 201 to 209, but we wanted 199 to 211. Okay, let's go a little further out. Let's go 195. There's the broken wing butterfly by 215. Ding. Okay. Now what? Now I have from 198.65 all the way out here to 211. Now you'll notice that if it got out there by the end of the trade, it's break even, but early in the trade, I'd be losing money. Let's put these numbers out there. Let's put 211 here. Yeah, I'm definitely going to have to steal some of your time today. My apologies. Okay, there's 199. I'm losing 274. There's 211. I'm losing 500. But am I? The Vega is negative. If the market goes up, where does volatility go down? Volatility goes down. I don't know if I've showed you guys this. You see this little cog? You guys see this cog down here? Right here. If I click on that, it opens up so I can do a volatility adjustment. Now, if the market moves up from 204 to 210, I would expect the volatility to drop at least 2 or 3%. So if I start dropping the volatility, immediately look at those little red hash marks. Those are my break evens. Where are they going? They're going wider and wider. And where's this purple line going? It's going higher and higher. So if it drops 3%, by the time it gets out here, I don't actually lose 500. I only lose 374. And if it takes until next Tuesday, because we really only have Wednesday, Thursday, Friday, then we get free Saturday, free Sunday, free Monday. Is that right? I think that's right. No, maybe it's Tuesday that we're back. Yeah, there we go. Now we're back. And now all of a sudden, out here at 211, I'm only down 177. But if it stays in the middle, right? If it stays somewhere around 205, like we thought it was, a week by the time we get to next Tuesday, this trade's up 800 bucks. Now I'd probably do less contracts in the beginning. Let's say we did 5. Still, you're up $400 on what? Nothing. Nothing happened. Nothing happened. Now, what if it did go up here? And then I said, you know what? I don't want to give up on this yet. Can I put a calendar spread? Right? Can I put a calendar spread out here? Let's go put a calendar spread out here. So you can see how they might combine. So let's go calendar. I'll go Jan 19 by 2 more wide. And we said we'd put this at around maybe like 215. But it would probably cost more than that. Let's say 80. I don't know. I'm kind of making this up as I go. And all right, something like this. Now, I got to get rid of this. And let's raise this back to 40. Yeah, something like that. Something like that. Let's now what? Now all of a sudden I have this extended range so that as time ticks, bing, 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 now I'm making money anywhere from 200 over to 217, almost a 10% range. That if it stays there. Now, are we thinking about these trades right now? I mean, I'm doing very short-term calendars. How are they doing? You want to know? They're crushing. They look great. Every one of them, the first calendar, the second calendar, the diagonal, all making money. While what else is happening? While the directional trade is also making money. So that's what it looks like with combination. That's exactly right. Combination. So that is let me go back. That is a butterfly. What do? We buy the wings. We sell the guts. That gives us a strategy that looks like this. What do I have? Delta neutral. I want it to stay as close to this as it can. Theta positive. I make money every day I'm in the trade. Vega negative. I want implied volatility to drop. If I want volatility to drop, where do I want it to start? High, higher. That's a butterfly. Yeah. Okay. Man, this one's taking way longer than I thought. I apologize. I'm going to kind of go a little faster now. So let's go through iron condors. Iron condors. Let's switch this so you can see it a little better. Advantages. Yeah, there can be some good returns. I'm going to say it's very similar. They are flexible. They have a higher cost compared to calendar spreads. Actually, I'm going to skip past this. Let's just build it. You know what? We're going to just build it. I don't like the way that these look. Let's go in. I'm going to leave this here. What am I doing with an iron condor? It's going to take me too long. So now I'm going to uncheck this. I want you to remember what this looks like. Negative, neutral delta, theta positive, vega negative. Yeah. Now I'm going to come in. I'm going to change calendar to iron condor. It doesn't matter which one we do because they're all the same. They both involve a bear call and a bull put. So it doesn't matter which one of these you choose. They're going to be, if you look, they're always exactly the same. So we're going to go where 205 is somewhere in the middle, but I'm going to widen these. I'm going to go, let's go 195 by 198. Nope. Let's go 211 by 215. I'm making adjustments to the bear call spread. This is a 211 by 215 bear call spread. Then I'm going to do a 199 by 195 bull put spread. And what do I have? There's that shape. Like a butterfly, but we lopped the top off. And when we lopped the top off, we gave ourselves the ability to expand this. But look at our ranges. We want it to be good above 198. We want it to be good below 211. If it gets out to 211, we're losing about $300. If it gets down here to 199, we're losing about $200. You can see your risk is contained. As long as it stays in the middle, what happens? Time starts to decay, you make money. If implied volatility drops, you make money even faster. You can see it's pushing that higher and higher and higher. So if you think the implied volatility is going to drop, that's going to give you a benefit. What can't I do with this? What can't I do with this? I can't adjust it very well. I can't add another one. If it breaks to the upside or the downside of a butterfly, just like if it breaks to the upside or the downside of a calendar, I can adjust by adding another. I can add a butterfly, I can add a calendar, or I can add a butterfly or a calendar to the downside. Either way. With this, I'm locked in. The goalposts are up. I need it to go through. So if it got up to like 213, we'd be like, yeah, I got to take my loss. Well, the loss isn't terrible out here, right? What are you losing? $300. If implied volatility drops, even less. Down here, it's only 150. But if implied volatility rises because it's dropping, if implied volatility rises, you can see what is it doing? It's pushing that purple line down. The more the implied volatility rises, the more it pushes down on the trade. That's the impact that volatility has. That's what Vega means to us. So it's hard because I want to show you these risk profiles so you can see what happens as price moves, as time moves, as implied volatility moves. If we take this back to today, what's my delta? Neutral, close to zero. What's my theta? Positive by 30. What's my Vega? Negative by 76. Positive by 25, negative by 63. I mean, if I put in two more of these, 36 minus 80, right? Look at the differences between these. Delta neutral, 31 positive theta, 76 negative Vega. 36 positive theta minus 88 negative Vega. So this pricing model is using Bjerkson Stensland. Yes, Bjerkson. So as opposed to, this is old school right here. You'll notice it doesn't change much but the Vega. If I go to binomial, a little bit of shift. If I go to Bjerkson Stensland, it's not a dramatic like, oh my God, you're using the binomial. It's not going to have that much difference. But yes, this is Bjerkson Stensland. So butterfly, iron condor, right? There's not really an iron condor variation for low volatility, and we don't need one. When it's low volatility, all we need, if we're directional, we buy options. If we're neutral, we do calendar spreads. If we're a little bit of both, we do diagonals. That's all you need for a bullish market. If you're worried about time or implied volatility being higher, then we start to do vertical spreads. Yeah, bull put, bull call, naked put. This, what I'm talking about now, iron condors. If we're doing iron condors, if we're doing butterflies, this is after the market has dropped, after a correction down 10%, after a bear market down 20%. So let me go show you what I mean very quickly here. So these are not very relevant. We're not going to do many of these right now, okay? But if I take this back, let's go back 2 years. And I said back around, October, November, December, right? All through this area. If our posture has improved and we think that we're out of the worst of this, well, we're still in this. That was hard. Who was trading that? That was hard. Yeah. Let's map this out. Let's change this to VIX. VIX, come on. Let's get to the VIX. What did the VIX tell us? The hell? What are my candles here? There we go. Where was the volatility? We weren't all the way up here. If you're at the highest point, you're not really feeling neutral, are you? You're feeling a little bit of fear. When that fear's come down, but options are still expensive, these options were mostly living between 21 and 27, right? Butterflies and calendars. Oh, that were fine until things started to get better. And then we saw the VIX drop even further. And we have the ability, like I said, to do a broken wing butterfly. A broken wing butterfly, if the market stays where it is, it behaves like a butterfly. If the market goes up, it behaves like a bull put spread. So it's kind of a hybrid, like a diagonal, where I get a little bit of the best of both worlds. If it stays where it is, I get the neutral aspect. If it moves, I get the directional aspect. I'm still not right if it goes down, but I'm certainly doing all that I can do to raise my probability of success. So yeah, sorry. I was looking at my slides and I'm like, I just don't like the way it was reading. I need to put a little more time to flesh those out a little bit more. I'm going to split these up. When we do this, the second pass, we're going to do one strategy each day so I don't have to combine. I realize that 8 weeks is not enough. It's really more of a, it's a festivalazzo, but it's not a festivalissimo. And if you know the Italians, they have levels. Festivalazzo is a little bit of a festival. Festivalissimo is, now you're talking. Round 2, I promise. Okay, let me get back to my slides. I hope this is making sense. We don't need it. I'm just saying that right now. We don't need these. I'm not going to put butterflies on in my own account. I'm not going to put iron condors on in my own account because I don't have the conditions conducive to these strategies. That's the point of what we're doing. I want to throw them at you. And maybe on our next pass, maybe in March or April when we hit our next pass on the options foundation, here's what I'm thinking. Trading foundations will start next week, but I'm going to condense it. I'm going to condense it from 3 months to 2. And then after that, I'm gonna expand options from 1 month to 2. So we're gonna go 2 months trading foundations, 2 months options foundations, over and over until we're all as comfortable as we can be. Let me know your thoughts on that if you think I'm on the right path. Okay, let me get back into my slides. Let me start this back up. Sandy says yes. If I have Sandy on board, sometimes I'm just thinking to hell with the rest of you. No, I don't think that. I'm just kidding. Advantages and disadvantages. They offer us limited risk exposure and a defined max loss, right? You saw that Iron Condor. What am I going to lose? If it breaks out one way or the other, I would lose a couple $100. Great. I can take that. If it stays in the middle, time is on my side. Bob says, sounds great to me. Love it. These are income strategies. These are things that just sort of are, they're probability strategies. When time is on my side, I've given myself the advantage of higher probability of success. What are the disadvantages? We talked about this. Limited profit potential. It's capped, right? It's capped. Things make a big move, you're in trouble. Complexity. They can be hard. When will we get the matrix? Next on Thursday. The matrix is coming. That'll be a slide that Gary will cover with you about low vol, high vol, bullish, bearish, neutral. That will come. So the matrix will come on Thursday. You don't want to miss getting to meet Gary, getting to listen to him, getting to see that. So that'll come. And they're just, it's more sophisticated. You've got more contracts. You definitely cannot compromise on liquidity. Whatever problems options may have with 1 or 2 contracts, it's even worse with 3 or 4. We got to have tight spreads, period. Tips for success. As always, Fred said, will we be able to print the matrix? If someone puts the request in, I can post the slides. I don't want to, I'll post those. Some of these I need to review and touch up a little bit. But yeah, I can post the slide into Discord and you can grab it from there. Or I can attach the slide to an email. I'll figure it out, Fred. I'll absolutely put it in a position where you'll be able to print that. Market trends. We've got to make sure we know exactly what the market is so we know which strategy to pick. We've got to know what implied volatility is so we know how options are priced. We've got to make sure that our risk management is always strong. We've got to have strategies to either get out if it's an Iron Condor or adjust if it's a butterfly or a calendar. Continuous learning, stay informed, keep coming to these. Can I have a go at making it? Make it and send it to me. Hell yes. You guys can always do. I mean, Steven just is like, I'm going to throw together some spreadsheets and shoot them at you. How about that? I'm like, yeah. Evolving strategies. We know that's how this market works. It evolves, we evolve. Pitfalls to avoid: not looking at market conditions, not adapting when changes are coming, not accounting for your risk management. Most importantly, transaction costs. I had a woman, all she did was Iron Condors. All she did was literally like 100 contracts. But she was paying $3 or $4 grand in commissions. All she had to do was change a broker. And we still have to pay for options per contract. If you're going to do a contract heavy strategy where there's 4 per, you got to make sure that your commissions are as cheap as possible. Okay. Summary. Yeah, I love advanced strategies. It gives me a lot of flexibility. So butterflies and condors have a place. I hope we don't see it for a while. These will come when we have a correction. I'll be like, all right, everybody, dust off your matrix. We need those Vega negative strategies. We need bull put spreads, naked puts. We need butterflies and iron condors and broken wing butterflies. I'm not going to buy those options that are expensive. I'm not going to do a counter spread where volatility could just absolutely decimate me. I'm going to make sure the strategy matches. Stay vigilant by adapting to market conditions, prioritizing risk management. Make sure you consider transaction costs when you make your brokerage selection, and we'll be in a good place. So Whew, that was a long one today. That definitely has to be split into butterflies one day, condors the next. That's the order that we'll go in. So next time around, I'll make the adjustment. You guys know I'll be water all day long. If you have now been through the foundations for trading and the options foundations, you don't want to miss the next round. The next round's going to be even better. Even better. Better because you're better primed for it. Better because I will make the presentations better. And we'll go from there. In Wizards, one guy, here we go. Questions. In Wizards, one guy mentioned scaling in. Scaling in is a longer term strategy of position sizing and money management. So, in fact, if you've ever heard of the turtle traders, phenomenal story. If Trading Places, classic market movie from the 80s, Eddie Murphy, Dan Aykroyd, Jamie Lee Curtis, phenomenal show, of course. If any of you watched that over Christmas, if you haven't, it's not too late. You can still watch it. It's loosely based on the turtle traders, but their strategies were based on finding a trend and really, I mean, they'd make most of their money on 20% of their trades. But what happens is you buy some, and then as it goes right, you buy some more, and then you buy some more, and then you buy some more, and then you sit on that and ride it as long as you can. So if you don't catch the trend, you only put a quarter of your position on, and then it stops out, and it's a small loss. By the time you put 4 on, you're tightening your stop, and if it stops you out, you're still going to make some money. So that, Stephen, love it. He said the orange crop came in as normal. You got to go watch that. That's an assignment. If you've never watched Trading Places, I need to hear your report on it. It's old, but it's classic. So there you go. Yes. So that is now I don't scale in because I'm a swing trader. I scale out. We scale out. We say, oh, we caught something. Let's book some and try to ride a little bit more because that's more of a swing trade scale system, scaling out. We put it all in at once and then we scale out. If you're a little longer term, you're not going to put it all in at once. You're going to put a little, and if you're right, you'll put a little more and then a little more. So that is scaling. There's a phenomenal PDF that's talks about the original. It's about 40 pages. I'll see if I can find it, but if you Google it, you might find it. That gives that looks at turtle rules and turtle trading, and it's really insightful because it shows you the elements that are required for that type of a system. So anyway, great question. Love the question. Great references a great movie. You have scaling on a log chart. Okay, well, that's something different. So Steven said scaling on a log chart. So a logarithmic chart is going to expand based on, right, that a $5 move from 95 to 100 is bigger than a $5 move from 145 to 150, right? Because the logarithmic scale is 5% versus only 3%. And so there they will expand a chart based on logarithmic values. That's a little bit different. Typically scaling, as referenced in the Market Wizards, it's going to be a money management strategy. It's going to be how they buy into a position. So anyways, there you go. Woof. Snuck a good question in right at the end of a long session there, Sandy. Okay. It's great to see everybody. Tomorrow morning. Oh, I just had somebody come in late. I can't believe it. Say goodnight, Scott. Bob's like, close it down. Tomorrow morning, we are meeting normal time. Thursday, 6:30 p.m. for Mountain Time, 8:30 p.m. Eastern. Gary is going to cover the implied volatility and the option Greeks. So important to tie it up with that, right? You can see how delta neutral, delta positive, theta negative, Vega. When we really start to tie those together and understand them on a portfolio and position level, it's going to help everything else. So that's Thursday. Yep. Tomorrow, Tomorrow morning we'll have our market open our midweek check-in. Thursday, Gary will wrap up options foundations with implied volatility option Greeks. Friday, I will close us down. Sunday, New Year's Eve, we're going to have a New Year's extra. We're going to wrap it up together. It's going to be a great session. We're going to talk about New Year's resolutions for trading, and we'll go from there. Thanks, everybody. It's fabulous to see you all. And thank you for the extra time. As always, happy trading.